You think you know what to do when markets crash, but I've watched brilliant people freeze, panic, and destroy decades of wealth in days. In the next few minutes, I'm going to walk you through these four investments that have survived every catastrophe I've witnessed since 1942 and the counterintuitive principles that separate those who build generational fortunes from those who lose everything. And if you stay with me until the end, you'll discover exactly why most crash strategies fail spectacularly and how to position yourself before the next inevitable collapse arrives. So before we dive in, do me a favor, hit that like button, subscribe if you haven't already, and tell me in the comments where you're watching from, because what I'm about to share could be the difference between financial devastation and the opportunity of your lifetime. Here's what separates winners from losers when everything falls apart. Let me be brutally honest with you. I've lived through 13 major market crashes between 1942 and 2022. 13 times I watched the financial world seemingly end. 13 times I saw fortunes evaporate overnight. And 13 times I did something that seemed absolutely insane to everyone around me. I bought aggressively while others sold in pure terror. The crash of 1973-74, when stocks dropped nearly 50% and stayed down for years. The crash of 1987, when the market fell 23% in a single day. The dot-com implosion of 2000-2002. The financial crisis of 2008-2009. I was there for all of them, checkbook in hand, buying wonderful businesses at prices that made my heart sing. But here's what you need to understand. What truly separates successful crash investors from everyone else isn't courage, it's preparation. You cannot, and I mean cannot, wait until markets are collapsing to figure out what you want to buy. By then, your emotions have hijacked your brain. Fear clouds every decision. Your hands shake when you try to place orders. You freeze when you should be acting decisively. That's why right now, today, while you can think clearly, I'm going to share the only four stocks I would buy if markets crashed 50% tomorrow. These aren't hot tips. These aren't speculative bets. These are businesses I've studied for decades, businesses with competitive advantages so absurdly durable that a 50% price decline would be a gift from the investing gods. Now, you might be thinking, Charlie, how can you be so certain? What if this time is different? I've heard that phrase, this time is different, at least 50 times in my career. And you know what? It's never different. Human nature doesn't change. Fear and greed don't change. The fundamental principles of business value don't change. What changes is price, and temporary changes in price create permanent opportunities for those who've done their homework. Let me take you back to October 2008. Lehman Brothers had just collapsed. The entire financial system was on the brink of complete meltdown. Every bank looked like it might fail. Credit markets were frozen solid. The Dow Jones had plummeted from over 14,000 to under 8,000, and it was still falling. I remember sitting in my office watching the panic unfold. Every expert, every talking head, every supposedly sophisticated financial professional was predicting the end of capitalism itself. And Warren wrote that op-ed for the New York Times. Buy American, I am. People thought we'd lost our minds. They said, the world is ending. How can you possibly be buying now? But we saw something they couldn't see through their terror. We saw that American businesses would still be operating in 10 years, 20 years, 50 years. We saw that people would still need insurance, still drink Coca-Cola, still use credit cards. The fear was temporary. The value was permanent. If you'd had the courage to buy in October 2008 and simply held on, you would have made 5, 6, 7 times your money over the following 15 years. The people who panicked and sold locked in catastrophic losses. The people who bought created wealth that changed their families forever. That's not luck. That's understanding the difference between price and value. So how do I select stocks to buy during crashes? Because this is crucial. Not every stock that drops 50% is worth buying. Most of them aren't. Some stocks crash because the business is fundamentally broken. Some crash because they were absurdly overvalued to begin with. Some crash 50 and then drop another 50 because the problems are worse than anyone realized. The stocks I want have 5 specific characteristics. First, the business must be nearly certain to exist and be profitable in 10 years. This sounds obvious, but most investors completely ignore it. They buy whatever's dropped the most without asking whether the company will even survive. Weak companies with too much debt, companies in dying industries, companies selling products nobody needs. They don't just decline temporarily, they disappear entirely. Second, genuine competitive moats. Something must protect the business from competition. Maybe it's a brand so powerful customers pay premium prices out of emotion and habit. Maybe it's network effects where the product becomes more valuable as more people use it. Maybe it's cost advantages competitors simply cannot match. Without a moat, even good businesses get destroyed by competition over time. Third, strong free cash flow generation. I want companies that produce more cash than they consume. Companies that can fund their own growth, pay dividends, buy back shares, and weather economic storms without needing to raise capital on terrible terms. In crashes, capital becomes scarce and expensive. Companies that generate their own cash control their destiny. Fourth, capable and honest management. Over 20 or 30 years, management decisions compound just like investment returns. Good managers allocate capital wisely and treat shareholders fairly. Bad managers destroy value through empire building and idiotic acquisitions. And fifth, critical for crash buying specifically, the stock must trade at a price offering significant margin of safety. Even great businesses can get cut in half during panics. But if you buy well below intrinsic value, time is on your side. You can afford to be patient. You can even afford to be wrong about timing. The margin of safety protects you from permanent loss. When I apply these 5 filters rigorously, very few stocks make the cut. But the businesses that pass all 5, those are the ones where a 50% crash isn't a warning sign, it's an invitation. The first investment that gets more valuable every single day, the first stock I would buy if markets crashed 50% tomorrow is Apple. Now, I can already hear some of you saying, Charlie, Apple's already enormous. It's one of the largest companies in the world. How much upside can there possibly be? And others thinking, if Apple crashed 50, wouldn't that mean something seriously wrong? Let me address both concerns directly, because understanding Apple correctly is absolutely critical to understanding modern business value. Apple is not just a technology company. Apple is one of the finest businesses ever created in the entire history of capitalism. And I don't say that lightly. I've studied thousands of companies over 70 plus years. I've seen great businesses and I've seen pretenders. Apple is the real thing, and most people still don't understand. Why? The iPhone isn't just a product. It's the center of over 1 billion people's digital lives. Think about that for a moment. Over 1 billion people carry an iPhone with them everywhere they go. They wake up checking it. They go to sleep checking it. They look at it hundreds of times per day. And they chose to pay a significant premium for this device, even though cheaper alternatives exist everywhere. That tells you something profound about the value Apple creates. People aren't buying iPhones because they have to. They're buying iPhones because they want to, because the experience is demonstrably superior, because the ecosystem is so brilliantly integrated that switching would be genuinely painful, because the brand represents something they want to be associated with. This isn't a commodity business where the lowest price wins. This is a business built on emotional connection, on ecosystem lock-in, on continuous innovation that keeps customers loyal for life. The switching costs are enormous, not just financial costs, but psychological and practical costs. When you've got your photos, your messages, your apps, your music, your entire digital life integrated into the Apple ecosystem, leaving is like moving to a new country. But here's what really excites me, and what most analysts still undervalue, the services business. Every single month, Apple collects recurring revenue from over 1 billion people. iCloud storage fees, Apple Music subscriptions, App Store purchases, Apple TV subscriptions, Apple Pay transaction fees, Apple Arcade, Apple Fitness, Apple News. The list keeps growing. This services revenue is recurring, high margin, and growing faster than the hardware business. 10 years ago, services was a small part of Apple's business. Today, it generates over $80 billion annually in revenue, and it's still in the early stages. As Apple adds more services, as more people join the ecosystem, as existing users spend more, this revenue stream will continue compounding beautifully for decades. This is the most valuable kind of revenue imaginable. It's predictable, it's sticky, it's high margin, it creates enormous shareholder value, and it's protected by those same switching costs I mentioned. Once you're paying for iCloud storage for your photos, canceling means risking losing memories. Once your family shares Apple Music, canceling disrupts everyone. Now, why would Apple crash 50? Probably because of some macroeconomic catastrophe, some global crisis, some general panic that drags down all stocks regardless of quality. That's exactly the kind of crash where you want to be buying aggressively. The business wouldn't be impaired. iPhone users wouldn't suddenly switch to Android because the stock market crashed. Services subscribers wouldn't cancel their iCloud storage because of a recession. The ecosystem would remain completely intact. You'd simply be getting a piece of this extraordinary business at half price. Let me put real numbers on this. Apple generates over $100 billion in free cash flow annually. $100 billion. At a 50% lower stock price, you'd be buying that cash flow at a dramatically lower multiple. And what does Apple do with that cash? Massive buyback programs that reduce share count every single year, growing dividends that reward patient owners, and maintaining a cash pile that gives them flexibility to invest in whatever opportunities emerge, whether that's artificial intelligence, augmented reality, healthcare technology, or something we can't even imagine yet. If Apple crashed 50 tomorrow, I would back up the truck. I would buy as much as I possibly could, not because I'm speculating on a quick recovery, because I'd be acquiring a piece of one of the greatest businesses ever built at a price that offers exceptional long-term returns, the kind of returns that create generational wealth. Why the best businesses don't make products, they collect tolls. The second stock I would buy in a 50% crash is Visa. And here's where most people's understanding completely breaks down. Most people think of Visa as a credit card company. They think Visa lends money to consumers and makes profits on interest payments. That's completely, utterly, fundamentally wrong. And understanding why it's wrong reveals one of the most beautiful business models ever created. Visa doesn't lend a single dollar. Visa doesn't take any credit risk whatsoever. Visa is something far, far better than a lender. Visa is a toll road on virtually every electronic payment made anywhere in the world. Every time someone swipes a Visa card anywhere on planet Earth, Visa takes a small percentage of that transaction, not the credit risk, not the default risk, just a small fee for processing the payment. The banks that issue Visa cards take all the credit risk. The merchants who accept Visa cards pay all the fees. Visa just sits in the middle, collecting tolls on trillions of dollars of transactions, flowing across its network every single year. Think about the absolute beauty of this business model. Visa doesn't need to build factories. Visa doesn't need to manage inventory. Visa doesn't need to worry about customers not paying their bills. Visa doesn't even need to worry much about competition once its network is established. Visa just needs to maintain its network and watch the money flow through like a river. The operating margins are extraordinary. Over 60% of revenue drops straight to operating income. That's a level of profitability that almost no other business can match. Manufacturing companies would kill for 20% margins. Retailers celebrate 10 margins. Visa operates at 60% margins because the marginal cost of processing one more transaction is essentially zero. And the growth runway, enormous. The world is still in the early stages of shifting from cash to electronic payments. In developed markets like the United States and Europe, maybe 60-70% of transactions are electronic now. But in emerging markets, in Africa, in Southeast Asia, and Latin America, the vast majority of transactions are still done in physical cash. As these economies develop, As more people join the banking system, as more merchants accept electronic payments, Visa's transaction volume will continue growing for decades. This isn't speculation, this is mathematical certainty based on global economic development patterns. Visa also benefits automatically from inflation. When prices go up, the value of each transaction goes up. Since Visa's fee is based on transaction value, inflation automatically increases Visa's revenue without the company needing to do anything at all. In an inflationary environment that destroys the value of bonds and fixed income investments, Visa's revenue grows automatically. It's a built-in inflation hedge. The competitive moat around Visa is absolutely massive. There are only two major global payment networks, Visa and MasterCard. Together, they process the vast majority of card transactions worldwide. Building a competing network would require simultaneously convincing millions of merchants to accept a new card, convincing billions of consumers to carry a new card, and convincing thousands of banks to issue a new card. This chicken and egg problem is nearly impossible to solve. Merchants accept Visa because consumers carry Visa. Consumers carry Visa because merchants accept Visa. New entrants cannot break into this self-reinforcing cycle without spending hundreds of billions of dollars with no guarantee of success. Now, some people worry about newer payment technologies, digital wallets, buy now, pay later services, cryptocurrency. But here's what most people completely miss. These technologies usually run on top of the existing card networks. When you pay with Apple Pay, the underlying transaction still goes through Visa or MasterCard. When you use PayPal, it's often connected to a Visa or MasterCard. When you use Venmo or Cash App, guess what's powering many of those transactions? The new technologies aren't replacing the networks, they're adding transaction volume to the networks. Visa gets paid regardless of whether you swipe a physical card or tap your phone or click a button online. Every electronic payment that flows through their network generates revenue. If Visa crashed 50% in a market panic, you'd be buying one of the highest quality businesses in the world at a significant discount. A business with 60% operating margins, a business growing revenue at double digits, a business with decades of runway as the world shifts to electronic payments, a business with a moat so wide that no competitor can realistically challenge it. That's the kind of opportunity I dream about. That's the kind of investment that makes you wealthy over 20 or 30 years. The membership model that prints money while others fight over pennies, the third stock I would buy in a 50% crash is Costco. Now, this might genuinely surprise you. Costco is a retailer, and retail is supposed to be a terrible business. Low margins, intense competition, vulnerable to e-commerce disruption from Amazon. Why on earth would I want to own a retailer? Because Costco isn't a normal retailer. Costco is a membership business brilliantly disguised as a warehouse store. And understanding this distinction, truly understanding it deep in your bones, is the key to understanding why Costco is one of my absolute favorite businesses. Most retailers make money by marking up products. They buy something for $10, sell it for $15, and pocket the $5 difference. This model produces terrible economics because competition forces everyone to match prices constantly. If one store charges too much, customers simply go somewhere else. It's a race to the bottom that destroys profitability. Costco operates on a completely different model, one of the most ingenious business models I've ever encountered. Costco barely marks up its products at all. The average markup is only about 11% compared to 25-30% at typical retailers. Costco isn't trying to make money on the merchandise. Costco is trying to offer such incredible value that customers feel absolutely compelled to pay the annual membership fee. And that membership fee is where Costco makes almost all of its profit. Think about what this means strategically. Costco has over 130 million cardholders. That's over 70 million households paying membership fees. The renewal rate is over 90. 90% of members renew every single year. That's subscription-like recurring revenue with almost no marginal cost to serve. Once you pay your membership fee, Costco doesn't need to spend significantly more money to keep you as a customer. They just need to keep offering consistently great value so you renew next year. This creates a virtuous cycle that competitors simply cannot replicate. Because Costco operates on razor-thin merchandise margins, they can offer the lowest prices. Because they offer the lowest prices, customers join and renew memberships eagerly. Because customers pay membership fees, Costco can operate profitably on razor-thin merchandise margins. It's a self-reinforcing loop that has been compounding successfully for over 40 years. Costco is also virtually immune to e-commerce disruption. Amazon cannot replicate the Costco experience. You cannot sell giant packages of toilet paper and cases of wine and fresh rotisserie chickens and prescription drugs and gasoline and eye exams through a website. The physical treasure hunt experience of walking through a Costco warehouse, discovering unexpected deals, loading up a cart with bulk purchases that'll last months, this cannot be digitized. The $4.99 rotisserie chickens are strategic loss leaders that drive traffic. The $1.50 hot dog and soda combo hasn't changed price since 1985, nearly 40 years. These are deliberate strategic assets that build customer loyalty in ways that pure e-commerce can never match. The customer demographics are exceptional. Costco members tend to be affluent, educated, and deeply loyal. They shop at Costco not because they have to, but because they genuinely enjoy the experience and appreciate the value. These aren't price-sensitive customers who'll switch for a slightly better deal. These are customers who've incorporated Costco into their lifestyle and family routines. Management has been absolutely exceptional for decades. They think long-term. They treat employees remarkably well, paying above-market wages and providing excellent benefits, which reduces turnover dramatically and improves customer service. They resist the constant temptation to raise prices or cut quality to boost short-term profits. They've earned the trust of their members through consistent execution over 4 decades. If Costco crashed 50%, it wouldn't be because the business was broken or facing existential threats. Costco's membership renewal rates don't decline because the stock market crashes. People still need to buy groceries and household goods during recessions. In fact, value-focused shopping becomes even more important. The business would keep humming along, collecting membership fees, serving loyal customers, compounding value steadily. You'd simply be getting this wonderful, durable, profitable business at a much lower price. That's not a crisis. That's an opportunity that makes me genuinely excited. Why this collection of businesses becomes more valuable when everything else falls apart. The fourth and final stock I would buy in a 50% crash is Berkshire Hathaway. Yes, my own company. And before you dismiss this as self-serving promotion, let me explain exactly why Berkshire would be one of my very top choices in a severe market crash, and why the reasoning reveals something profound about crisis investing. Berkshire Hathaway isn't really a stock in the traditional sense. Berkshire is a carefully constructed collection of over 70% wholly owned operating businesses, plus a massive portfolio of publicly traded stocks, plus over $150 billion in cash and short-term treasury bills as of 2022. When you buy Berkshire, you're buying incredible diversification in a single investment. You're buying insurance companies like Geico and General RE that actually benefit from market turbulence. You're buying BNSF Railway that moves essential goods across America regardless of economic conditions. You're buying Berkshire Hathaway Energy with utilities and pipelines that generate steady cash flow. You're buying See's Candies and Dairy Queen and Fruit of the Loom and Benjamin Moore and Duracell and dozens of other businesses serving fundamental human needs. You're also buying major stakes in Apple and Coca-Cola and American Express and Bank of America and other wonderful businesses we've accumulated over decades. This diversification is extraordinarily important in a crash scenario. Some businesses do better during recession, some do worse. But by owning a collection of businesses across many different industries, Berkshire's overall earnings are far more stable than any single company. We don't depend on one product, one market, one management team. We've got multiple engines of value creation working simultaneously. The insurance businesses actually benefit from market crashes because Berkshire has massive amounts of cash available to write policies when competitors are capital constrained. We can be aggressive when others must be defensive. The operating businesses keep generating cash regardless of stock market conditions. People still need insurance, still ship goods by rail, still consume electricity. But here's the real secret advantage Berkshire has in a crash. The cash, over $150 billion sitting on the balance sheet, earning treasury returns, waiting patiently to be deployed when other companies are struggling to survive, when credit markets are frozen, when everyone is desperate for capital. Berkshire can be the buyer of last resort. Berkshire can make deals on terms that are incredibly favorable, terms that nobody else can offer because nobody else has the capital and stability we have. We did exactly this in 2008, investing in Goldman Sachs and General Electric on terms that generated billions in profits. We can do it again and again whenever opportunities arise. This optionality is enormously valuable. Most companies have to sell assets during crashes to raise desperately needed cash. Berkshire can buy assets during crashes because we have cash and no debt pressures. This fundamental asymmetry means Berkshire often emerges from crashes even stronger than before, having acquired businesses and made investments at bargain prices that compound for decades. There's also zero debt to worry about. Berkshire's balance sheet is rock solid, one of the strongest in the world. There's no scenario where Berkshire cannot meet its obligations. No risk of bankruptcy, no risk of forced asset sales at terrible prices. This safety allows us to be aggressive when others must be defensive. The management succession is now firmly in place. Greg Abel is ready to take over as CEO when needed. The culture of rational capital allocation, of long-term thinking, of integrity and shareholder focus. This culture is deeply embedded in the organization. It doesn't depend on any single person. If Berkshire crashed 50, think about what that would mean mathematically. You'd be buying a company with over $150 billion in cash at a lower price than the cash alone. You'd be getting the 70 operating businesses essentially for free. You'd be getting the stock portfolio for free. This is the kind of mathematical absurdity that sometimes happens during crashes, where prices disconnect completely from intrinsic value. When that happens, you buy with both hands. Now, let me bring everything together, because choosing these 4 specific stocks isn't really about the companies themselves. It's about the principles of successful crash investing. If you understand why I chose Apple, Visa, Costco, and Berkshire Hathaway, you understand how to evaluate any opportunity when markets decline sharply. The common thread across all 4 is absolute durability. Each of these businesses will exist and thrive regardless of what happens in the broader economy. iPhones will still sell. Card transactions will still process. People will still shop at Costco. Berkshire's operating businesses will still function. A crash doesn't impair these businesses fundamentally. It just temporarily changes the price at which you can buy them. The second common thread is genuine competitive advantage. Each business has something substantial that protects it from competition. Apple has its ecosystem and brand loyalty. Visa has its network effects and scale. Costco has its membership model and value proposition. Berkshire has its diversification, culture, and balance sheet strength. These advantages compound over time. The longer you hold, the wider the moat becomes. The third thread is robust cash generation. Each business produces significant free cash flow year after year. They don't need to raise capital to grow. They can fund their own expansion, reward shareholders with dividends and buybacks, and weather economic storms without financial distress. Cash generation is the ultimate measure of business quality. The fourth thread is management quality. Each company is run by people who think like owners, who allocate capital wisely, who prioritize long-term value over short-term metrics. Management matters enormously over long periods because their decisions compound just like investment returns. Let me address something critically important. Some of you are probably wondering, should I wait for a crash to start investing? Absolutely not. Trying to time the market is a fool's errand. I've watched smart people waste years waiting for crashes that never came or came far later than expected. Nobody can predict when crashes will happen. If you sit on cash waiting for a 50% decline, you might wait 5 years, 10 years, or even longer. You'd miss enormous gains while waiting for a crash that doesn't materialize on your preferred timeline. The right approach is to invest consistently in quality businesses at reasonable prices, build positions gradually over time, and when crashes do inevitably happen, and they will happen, I guarantee it, be prepared to invest significantly more aggressively. That's the key insight. You don't have to be all in or all out. You can maintain a normal investment posture during normal times and shift to a much more aggressive posture during crashes. This requires having cash available. This requires maintaining a watch list of businesses you want to own. This requires having the emotional fortitude to act decisively when everyone else is panicking. I keep emphasizing this because it's so fundamentally important. The biggest obstacle to successful crash investing isn't knowledge, it's temperament. When markets crash 50, the news is uniformly catastrophic. Every headline screams disaster. Every expert predicts further declines. Your own portfolio shows massive losses. Every instinct screams at you to sell, to get out, to protect what you have left. But that is precisely when you need to be buying aggressively. The moment of maximum pessimism is the moment of maximum opportunity. Not because you're smarter than everyone else, not because you can predict the future, but because you've done the work beforehand, because you know which businesses you want to own, because you understand that great businesses continue operating profitably regardless of stock prices, because you recognize that crashes are temporary, but value is permanent. I've been investing for over 70 years. I've made a lot of money, far more than I ever imagined possible when I started out. But I didn't make that money by being clever about market timing. I made it by owning great businesses for extraordinarily long periods. I made it by being greedy when others were fearful. I made it by having the patience to let compound interest work its magic over decades. The 4 stocks I've shared today, Apple, Visa, Costco, and Berkshire Hathaway, represent the very best of American business. They have competitive advantages that will last for decades. They generate enormous amounts of cash. They're run by capable people who think like owners. And in a crash, when their prices drop 50%, they become the opportunity of a lifetime. But here's what I desperately want you to understand. The specific stocks matter less than the principles behind their selection. If you can identify businesses that are genuinely durable, that have real competitive moats, that generate strong free cash flow, that have excellent management, and that are available at prices offering significant margin of safety, you'll do exceptionally well as an investor over time. Whether you own these exact 4 stocks or different companies that meet the same rigorous criteria, the results will be similar over long holding periods. Focus on the principles, not just the specific names. Crashes will come, they always do. The entire history of markets is a history of periodic panics, where prices decline sharply and investors lose their minds. Some crashes are triggered by financial crises, some by geopolitical events, some by unexpected shocks nobody saw coming. The specific trigger doesn't matter at all. What matters is how you respond. Will you panic and sell at the bottom, locking in devastating losses? Will you freeze and do nothing, missing the opportunity completely? Or will you have the preparation and courage to buy aggressively, acquiring wonderful businesses at bargain prices? The choice is entirely yours. But let me tell you from 7 decades of experience, the investors who build real, lasting generational wealth are the ones who buy during crashes. They're the ones who see opportunity where others see only disaster. They're the ones who act decisively when everyone else is paralyzed by fear. Let me share something else. Most investors get completely wrong about crash investing. They think they need to catch the exact bottom. They think if they buy when the market's down 40% and it goes down another 10%, They've made a terrible mistake. This is completely backwards thinking. If you buy a wonderful business at a wonderful price, it doesn't matter at all if the price goes somewhat lower after you buy. Matters is where the business will be in 5 years, 10 years, 20 years. The difference between buying at the absolute bottom and buying 10% above the bottom is essentially meaningless over long holding periods. But the difference between buying during a crash and not buying at all, that difference is absolutely enormous. That difference is life-changing. That difference separates wealthy families from everyone else. I have never, not once in 70 years of investing, caught the exact bottom of any crash. I bought during 2008, but prices kept falling for months after my purchases. I bought during the dot-com crash, but prices declined further before recovering. Every single time I bought too early according to short-term price action. And every single time those purchases turned out to be incredible investments because I was focused on value, not on timing. I was focused on what the businesses would be worth in 10 years, not what the prices would do in 10 weeks. This is the mindset you absolutely must develop. Stop trying to be perfect. Stop waiting for the all-clear signal. There is no all-clear signal at the bottom of a crash. At the bottom, everything looks completely hopeless. The news is catastrophic. The experts are predicting more declines. Your stomach is in knots. That's exactly when you should be buying. If you wait until things look better, until everyone feels comfortable again, you'll have already missed most of the recovery. The biggest gains come in the first months after the bottom, when things still look terrible. Let me address how much to buy during a crash, because this is crucial. First principle, never invest money you might need in the next 5 years. Crashes can last longer than you expect, and you don't want to be forced to sell at low prices because you need cash for living expenses. Second principle, invest incrementally rather than all at once. If the market drops 50%, don't put all your available capital in on day one. Buy some. Wait. If prices drop further, buy more. This averaging approach benefits you at different price levels. Third principle, maintain enough liquidity to take advantage of extreme opportunities. The very best deals often come at moments of maximum panic when sellers are desperate and buyers are completely absent. Having cash available during these moments is enormously valuable. I want to talk about the psychological preparation required because this is where most people fail completely. It's easy to say you'll buy when stocks are down 50%. It's incredibly difficult to actually do it when you're living through the crash. Your brain is evolutionarily wired to avoid pain and danger. Buying stocks during a crash feels painful because you're likely to see immediate additional losses. Your portfolio might drop further. You might feel stupid for buying when everyone else is selling. Every evolutionary instinct tells you to run away from danger and a crashing. Market triggers all those danger instincts. The way to overcome this is through preparation and conviction. Preparation means doing all the work beforehand. Know exactly which businesses you want to own. Understand their competitive advantages deeply. Calculate rough estimates of their intrinsic value. Have a specific plan for how much you'll buy at different price levels. When the crash comes, you don't have to think. You just execute the plan you already made. Conviction comes from genuine understanding. If you truly understand why Apple or Visa or Costco or Berkshire are great businesses, you won't be shaken by temporary price declines. You'll recognize that the underlying value hasn't changed. You'll see the crash as a gift rather than a threat. But this conviction only comes from deep knowledge. Surface-level understanding evaporates completely under emotional pressure. Only genuine understanding survives the emotional storm of a crash. Let me tell you what not to do, because avoiding mistakes is just as important as making good decisions. Don't sell your existing holdings just because prices have dropped. If you owned a great business at higher prices, it's an even better value at lower prices. Selling locks in losses and denies you the recovery. Don't try to get clever with market timing, attempting to sell before crashes get worse and buy back at the bottom. This sounds brilliant in theory, but almost never works in practice. You'll sell too late and buy back too early, or worse, sell and watch prices recover without you. Don't abandon your investment plan because of fear. If you had a sensible long-term strategy before the crash, that strategy is still sensible during the crash, probably more sensible because prices are lower. Don't listen to the doom mongers and panic merchants. During crashes, the most bearish voices get the most attention. People predicting total collapse become media celebrities. But they're almost always wrong. The world doesn't end. Markets recover. Businesses continue operating. Life goes on. Don't invest money you cannot afford to lose. This should be obvious, but it bears repeating. Crashes can last longer and go deeper than anyone expects. If you invest money you need for rent or emergencies, you might be forced to sell at the worst possible time. Don't concentrate everything in a single stock. Even wonderful businesses can face unexpected challenges. Diversification across several high-quality companies provides essential protection against the unknowable. And never, ever borrow money to invest during a crash. Leverage can absolutely destroy you. If you borrow to buy stocks and prices drop further, you'll face margin calls that force you to sell at the bottom. This is how people go completely broke during crashes. Stay away from leverage. The 4 stocks I've discussed today are my choices based on my analysis and my specific criteria. Your choices might be different, and that's perfectly fine. What matters isn't that you own the exact same stocks I would own. What matters is that you apply the same rigorous principles. Look for genuinely durable businesses. Look for real competitive advantages. Look for strong cash generation. Look for quality management. Look for reasonable prices with margin of safety. If you find businesses meeting these criteria, you'll do well regardless of whether they're the same businesses I've chosen. The goal isn't to copy anyone. The goal is to develop your own ability to evaluate businesses and recognize value. When you can do that skillfully, you don't need to rely on anyone else's stock picks. You can generate your own ideas and have the conviction to act on them. This self-reliance is ultimately what separates successful investors from the crowd. You don't need to be a financial genius to succeed at this. You don't need inside information or sophisticated mathematical models. You just need to own great businesses, hold them for long periods, and buy more aggressively when prices decline dramatically. That's the formula. It worked for me since 1942. It will keep working as long as markets exist. So the next time you see headlines about a market crash, the next time you watch your portfolio decline sharply, the next time everyone around you is panicking and predicting doom, remember what I've told you today. Remember these 4 stocks. Remember the principles behind them. Remember that crashes are opportunities, not disasters. And act accordingly. Your future self will thank you profoundly. Now go hit that like button, subscribe to this channel, and tell me in the comments which of these 4 investments you find most compelling. Because the next crash is coming. It always does. And the prepared will prosper while the unprepared will panic. The choice is yours.